Hello, good day to you. Happy Friday if you're watching this on a Friday. Hopefully you're looking forward to the weekend, and hopefully you've got some nice plans lined up. So again, just another quick video. Slightly more and more of you watching it. Great, really happy to see. And really, it's a good way just to talk for me to talk to you guys about stuff. And for you guys to either contact me directly for more questions or for feedback. All right. So today I just want to talk about a couple of hot topics right now. Okay. And you've heard me speak about these before, and we've probably talked about them on our review. And the title of this is how to hedge in volatile times. All right. So focusing on a few things. First, high inflation. Okay, inflation's been persisting for well over 12 months now. This time last year, we had seen it creep in. Inflation got super high, super quickly, and it's still high. It's coming down slightly, but it's still there. Interest rates, okay, interest rates keep going up. But as we know historically, interest rates don't stay high, okay? So when are interest rates going to start coming back down again? How do you protect against that? Okay, and as in the title, volatile times, all right? Well, you will have seen last week, it's probably read from my market update, but the markets were a little bit choppy, all right? And how do we mitigate that? Feedback I get from you guys, the clients, is that you understand that now's the time to invest. You understand that you can get invested at a really cheap rate, but you guys just don't want to see your investment drop. Okay, and I understand that completely. I myself, I mean, I'm high risk, but I'm keep seeing my investments drop further and further. I understand that feeling. So what I want to talk to you about today is an opportunity that we have through Devere. You will have heard of me speak about similar versions of this. And as you guys know, because of our size, because of our relationships that we have globally, we're able to bring stuff to the market for you guys that is attractive and will help mitigate some of these things that I've just mentioned. Okay. And actually, the biggest thing that I'm going to present to you now is 100% capital protected. Okay. So what that means is any money that you invest is 100% protected. You will get back 100% of your capital. All right. So let me get into it. All right, and slide down. So this has been brought to us by Barclays. Okay, and most of you, I'm sure, will know who Barclays are. I bank with Barclays. This is super exciting for me, that we're working with them a bit more. And as mentioned, 100% capital protected and based on global markets. Okay, so by that, it's got exposure to the S&P 500s, the Nikkei 225, and the Euro Stoxx 50. Just in layman terms, okay, that's the US, Japan, and Europe. All right. It offers a semi-annual coupon of 3% per semester, 6% annually, and that is only in US dollars. Okay, so this is a US dollar only investment, and we're going to use $100,000 as in the example here for just to help you guys understand. Really key thing to note, that 3%. Every semester, it accumulates. Okay, so that's not paid out to you. That accumulates up until the auto redeem feature kicks in. All right, so let me get into it, I guess. So on the 31st of March this year, okay, Barclays are going to look at these three markets and they're going to assess what level they're at. Once they've had a look, okay, they're going to mark those levels at 100%. Now, the way that this works is essentially it's based on the worst performing indice. All right. So let's say, for instance, we get to the end of the 6 years, okay, and all the indices are on or above 100% where they started. Okay, well, you get your full capital back 100% because your capital is protected. Okay, and that's actually 12 lots of 3%. Okay, so that's 12 lots, 3%. Okay, and that's actually 36% across 6 years. Based on a $100,000 investment, that's $36,000. Okay, fantastic. And you're getting capital back. So inflation is not going to stay high forever. It's going to come down. Still need to beat inflation, or you at least need to be competitive with it. 6% per annum, that's quite competitive. Interest rates right now are high, but they're going to come back down again. Okay, could be as early as the end of the year. That's seeming more and more unlikely. Okay, so you might need to think longer than 12 months. All right, 6% per year over a 6-year period. Well, you will be beating interest rates, I believe, in my opinion. Okay, well, so you might be asking me, all right, you mentioned about an auto redeem feature. Okay, yes, you're right. So the auto redeem feature kicks in after year 2. Okay, and what that essentially means is after year 2 onwards, if the worst performing indice is above 100%, okay, it will auto redeem, okay, and pay out those coupons that have been accumulated along the way, okay, and your full capital. So, for example, let's just say, and I'll do this in a different color so that we you can see what I'm looking at. If, for example, 3.5 years in, okay, at this point here, all the indices are on or above the 100% level. Okay, well, you're going to have accumulated 7 lots, 3%. Okay, 21% return, $21,000, and that will get paid out on that point. Okay, the coupons accumulate. Okay, they don't compound, they accumulate. Okay, so as you can see, if we continue to experience what we've been experiencing for another 12 months, okay, well, you're going to be already halfway through that period to the early redeem. If after 2 years we're in a better position, well, you're going to get your capital back and a return. Okay, and actually this is designed for that sort of medium term, short to medium term investment, where you're still getting a return over some choppy periods. As I've said, markets are still volatile, and we don't know how long that's going to last for. So in my opinion, we could be looking at towards the end of this quarter. Some analysts are saying at the second half of this year, but again, that depends on what the inflation's doing, and the interest rates depend on what the inflation's doing. Okay, so let's hedge against that. Let's hedge against market volatility, and let's protect your capital at the same time. Just to jump into what those markets have been doing. Okay, so for the last 12 months, the S&P 500 is actually down 8.76%. As you know, a lot of tech makes up the S&P. Tech has been hard pushed by the inflation because if you're a tech company, your profit margin gets squeezed. You're seen as an unattractive investment, and therefore a lot of people switched out of tech and into more inflation-proof areas, such as energy, for example. Nikkei 225 is actually up over 7%. Over in Asia, okay, they're finally coming out of lockdown or COVID restrictions for the last 2 years. And that means people have been sat on a load of cash. So what they're going to do, they're going to go spend it. All right, so that market's done particularly well for the last 12 months. And Europe, okay, well, after Putin invaded Ukraine, European markets sold off dramatically. And actually, it's done quite well over the last 12 months. Europe has learned how to deal with storing energy, making sure that households are catered for. And also a lot of people are traveling there now, and a lot of people are traveling out of there, that people are spending money regardless of the inflation. You've got wage inflation coming in, and you could probably expect that market again to be choppy and a little bit volatile, but I don't foresee that it was going to last longer than 2 years. All right, so nice, quick, easy. Okay, just really want to talk to you guys about it. Really, really exciting opportunity. I think it's something that everybody should consider. Your capital is 100% protected. 100% protected. So you'd be crazy not to. Get a return, invest while the markets are volatile, and take advantage of, you know, being able to protect yourself for the medium term, short to medium term, against those 3 things that I've mentioned. All right, listen, thank you very much for your time. Thanks for watching, and please contact me directly and let's discuss this. Please book in using the link below through the Microsoft booking system, and let's have a conversation about this, because this is carries zero risk for your capital as an investor. All right, thank you.